So we have a little feng shui going on behind me over here. We have a little fountain. We've got some nice indoor palm trees growing. We're in the atrium of my office building. It's lovely in here. So we're going to need a little feng shui when we talk about market volatility due to a potential, well, I should say the subject of impeachment. So it's a big deal. This is the word that's going around, the I word. What does it mean for investors? We have to take a look at history, but there are not a lot of samples to look at. So it's a very small sample set. But during the Nixon impeachment era, the Watergate era, because Nixon wasn't actually impeached. It was we were leading up to that, but it actually didn't happen. But the point is, he resigned. But during that time, there was a lot of volatility. Markets were down stock market was down about 40%. But that was also in a time of economic duress, the Arab oil embargo. We had a severe recession that lasted over a year, okay? Then we have the Clinton impeachment. So Clinton was actually impeached, not removed from office, obviously, and there was a fair amount of volatility during the impeachment from the beginning to end. From peak to trough, there was a 20% drawdown in stocks, which basically recovered right away as soon as the impeachment was over. And we just finished out the 1990s, ending in 2000 with a great bull market that turned into a horrible technology-led bear market. So we don't have a big sample set in the modern era. But to take it to now, we hear the word impeachment. Maybe it happens, maybe it doesn't. At this point, I still would say it's really just speculation, okay? Whatever political way you roll, this is all basically speculation at this point. You really don't know, okay? But what we do know is this: when Trump became president, January 20th till now, today is August 23rd, the stock market is up about 24%. So my sense, if the tax cuts that were enacted last year were to be withdrawn, maybe we could see a 24% drawdown in equities. So I'm kind of looking at that as a worst case scenario, pending that we don't go into a severe, deep recession, okay? But having said that, there could be a lot of volatility, but I think market participants think two things, okay? This is the overall read that I get from the market. That number one, we pretty much know that markets recover, and it's the economics, interest rates, GDP, the corporate earnings. Those are the real important issues that affect stock prices and financial markets. The other thing is that maybe market participants feel that they've squeezed out of President Trump as much as they're going to get. We had the tax cuts already. We've had a lot of regulation rolled back. So a lot of investors are thinking that, well, you know what? Whether if Trump is removed from office or impeached or his agenda is slowed down, by the way, that removal from office part, that is real speculation, because just because a president is impeached doesn't mean that the Senate has enough votes to actually remove a president from power. So we're really getting ahead of ourselves by talking about that. But the key is this: if worse comes to worse, my sense is the entire rally that we've had since Trump became president, about a 24% drawdown, could happen. That's my sense. I don't think we even get it to go that far, and then a recovery. And I think investors are conditioned to think now in terms of when we've had severe geopolitical shocks, stock markets, bond markets, etc., have typically recovered from these. Thanks for listening. I did write a post exactly about this about a year ago. I'll post it below. And if you have any questions, please hit me in the comments section below. I'll be sure to get back to you. Thank you.